I thought, we don't always do it, but I thought it'd be nice to maybe take some questions from the audience. If you want to ask a question, you got to come up to this mic. Keep in mind, there's a few hundred people watching this online, and if you don't come up and ask the question to the mic, they will not hear it. So if you want to ask a question, come up to the mic. Does anybody want to start one off? I can do some general questions for these guys, or I can just go right to Q&A if people have questions they want to ask. And I can barely see the audience because I'm not kidding about the Lubyanka lighting in here. It's very bright in my eyes. Okay, someone is approaching the mic.
Nobody said anything about uranium that I can recall.
Okay.
I'm wondering if the panel has any opinions about why we have the sudden drop in uranium and what do we need to look for going forward?
Okay. So anybody got thoughts on the short-term uranium price move? Why? Yeah, well, obviously an opinion longer term, but any thoughts on why it just had that drop that it had?
Well, I mean, it's the spot uranium being bought by the trust. It's basically a hoarding mechanism, a financial vehicle. It's not really plugged into the real uranium usage world, and the market will like bash it back and forth and do whatever with it. So it's not. It's what the long-term prices are doing that you really have to pay attention. Not.
So I mean, you think the spot price is just, well, Sprott, I guess.
Yeah, it's just a manipulation.
It's not a reflection of the real market. I'm not paying close enough attention. How much difference is there right now between the spot and the long term? Does anybody know? I don't.
Well, I think, yeah, the spot price, exactly. The spot price is not a good reflection. It's more about the market condition. You know, market condition got worse. Everybody's selling. There's a hedge fund, some hedge fund I heard was just completely get out of commodity, right? If not go negative, so they're selling everything in the past few weeks, including uranium. So, and then it's thinly traded, very easy to go down, but also very easy to go up. Right, so I think even the Russian-Ukraine war finished, with the Russian sanction was still on for years to come until Putin, you know, he got assassinated or he quit. Both are unlikely events. So uranium will likely be elevated. Another factor to consider, I've been seeing reports that China want to increase their nuclear weapon, not power, weapon. Because they saw what happened to Russia, and Russia has a lot of nuclear weapons, and United States didn't want to get close to them, right? So they want to have more nuclear weapons. That means more uranium demand. Yeah.
Not a good reason.
One of the things people don't understand is that the uranium that goes into a nuclear power plant is like 0.1% of the uranium that trades for whatever, U3O8 that trades for $50 a pound. And the perverse thing that's happening now is we have a uranium problem because uranium gets shipped to Russia where they have the processing plants to make the nuclear fuel that the power plants need. And that now is a problem because of the sanctions against Russia and the Ukraine situation. So that's, you know what the spot price is doing for ordinary uranium isn't really reflective of the problem that we have now in the nuclear sector until they build processing facilities, fuel processing facilities in North America.
So you're saying that would be that's a supply, that's a demand issue, because why go and buy uranium? Why go and buy spot uranium if you can't get it upgraded?
That's right.
Yeah. Okay. Weird, strange market. Does anybody else have a question? That was a good one. Oh, seriously, come on. None of you people has a question? Hi.
Hi to the panel. The conversation this last 2 days has been very parochial in that it's involved the Americas, so to speak. I'd like to know your comments on the fact that the EU, Central Bank of Europe, the Chinese bank, and the Bank of Japan are all trapped, given the rise in interest rates, the fact that they've been buying their own bonds at a discount, and this has been going on since 2014, and there's been no mention of that in the context or as a backdrop to all of the selling that's going on.
Right.
So I'm curious as to the panel's view.
Well, I mean, we have seen a strange situation. I don't think, I mean, you know, the ECB has been doing, you know, QE for a decade, more or less. That's helped keep their rates down. Bank of Japan's a lot more explicit about it. I mean, they're you know, Bank of Japan has been undertaking what's called yield curve control for at least 10 years now, which generally involves buying the short end and selling the long end of the curve. And what you're trying to do is control rates and make sure they don't rise. And the reason why you saw the yen fall apart, although I think it's bouncing a bit now on fear buying, because perversely the yen is actually a risk-off currency. But a lot of the drop you've seen in the yen is really because everybody knows the Bank of Japan is steadfastly refusing to raise rates. And there's traders out there trying to break the yen. I don't think the drop we've seen in the euro, because that's usually where you end up seeing these things expressed as in currency movements in these different blocks. But I mean, obviously both the yuan and the euro have both also been very weak relative to the US. I don't think in either case that's necessarily traders coming against them because they know that they're trying to control their yield curve. The ECB kind of feels like they've given up on the idea that they will do 2 or 3 rate increases later this year. But we do, you know, you do have an unresolved situation, and we probably will have for all eternity, quite frankly, where all of this debt that was created, 1, to control the yield curve, and 2, to just provide monetary and fiscal, because the central bank usually ends up holding the bonds when governments do these fiscal spending regimes. Nobody really knows where that's going to go at the end of the day. I have to admit I'm one of those people who, well, I'm highly skeptical about a lot of parts of the theory. I can't help but think that we are entering the age of modern monetary theory. And it's not because I love it as an economic model. It's because it's one of the few economic models that lets central banks do what they really need to do, which is openly monetize the debt and just say, yeah, we're just going to create $10 trillion, buy all these bonds, and burn them in a barrel in the back parking lot. I mean, I think that's coming. I don't think anyone knows what the impact's going to be. I mean, in theory, the impact could potentially be a big drop in, say, the dollar, but the problem with currencies is they don't trade. There's no such thing as trading a currency. You don't trade a currency. You trade a currency pair. You always trade pairs. So if you're buying one, you're selling another. So I don't quite buy into the hard asset friend, you know, my hard asset friends that go, well, that means the dollar's going to go to zero. I have my doubts about that because it's, you know, going to zero against what? I mean, they're all a piece of crap. So I think it's all relative. But I think you could have a big, you know, you may have a big downshift where, you know, hopefully what it means is you'd see a bunch of currencies basically sold down in relation to, say, you know, it'll effectively show up as inflation because you'll see currencies get sold off in relation to gold, real estate, commodities, you know, take your pick, some kind of hard asset. But I can't help but think that's coming, and it's not because, you know, I'm not really a gold bug or a silver bug. You know, to me, metals are metals. I mean, it's just stuff that I trade. But I am in the camp that says, you know, I don't really see another way out. So I think what's effectively being QE operations and yield control, I think at some point here, probably not too far in the future, it's going to morph into some kind of MMT, like, screw it, who are we kidding? Let's just print the damn stuff and buy the bonds and burn them in the back parking lot. Like, I don't know. You guys got some thoughts?
I mean, I certainly would agree. I think that, you know, that in some ways, unofficially, maybe MMT kicked in 2008, 2009, if you look at the Fed's asset balance sheet. And if you look at what happened since COVID hit, I think that they've just sort of taken it up another order of magnitude. And I think we probably already have unofficial MMT. And as much as we're sold it as, you know, some sort of a panacea, there are people, obviously, that criticize it. A lot of people just don't understand it well enough to really figure out, is it a good thing or a bad thing? But because you have criticism of it, I think that, you know, people like central planners will do the best job they can of selling it. And, you know, actually talk about that in the book. I say, you know, if something is, if you repeat something often enough, no matter how silly it sounds, eventually people will believe it. And I think that MMT falls perfectly underneath that, that sort of framing. And it's absolutely, you know, if it's not here yet, it's definitely coming. And there aren't going to be that many places to hide.
One of the interesting things with MMT, and you're right, I mean, most of the people that I see railing against it clearly have never read about it. They don't actually know how it works, but it just pisses them off on principle, I guess. Especially if you're a hard money type, you find the idea of MMT very offensive. One thing about MMT that a lot of people don't understand is that, you know, any economic model, they have, you know, bounding conditions, and the bounding condition for MMT is actually inflation, ironically. Because if you believe in MMT, you're saying, well, no, it's not a matter of, it's not old school where the Treasury says, can we afford it? Like, of course we can afford it. We're the Treasury. We can just print the damn stuff. The bounding condition is inflation. That's what tells an MMTer, like, okay, we've got to pull in the reins. And that, where MMT kind of falls apart for me is I don't know, it's not clear what happens when you get to that point.
Right.
And there's sort of, you know, if you look at inflation and if you think monetarism is the only reason for the inflation we're seeing right now, I'm not sure I buy that, but if you're someone that thinks that way and you go, well, even if you're an MMTer, that means at some point you got to put the brakes on.
Exactly.
So even they don't really have an exit ramp. I mean,
agreed. I mean, you know, from what I understand about it is that one of the arguments that they have is that you know, if it creates too much inflation, one of your bigger tools is to start raising taxes, right? But who's able or willing to do that? I mean, that's so unpopular. How likely is that? Even if they did it a little bit, I mean, you've got Biden talking about doing that to some extent, but it's not popular. It doesn't get you reelected.
no.
What are the odds? Nobody likes it. It's not, the population doesn't like it. The leaders don't like it. The odds that that's going to happen to start reining in inflation are next to none.
Yeah.
Yeah, exactly. Get rid of student debt will get you elected.
Right.
Right. So
Well, sounds great.
that's a thing in happening in the United States. That's a $300 billion, right? Got created or something got, you know, generated just to get people like, you know, all these people who pay student loan, actually who don't have student loan actually get lost, and all the people who has that, you know, and then the government just created $350 billion. I mean, maybe next round we have another president, they want to pay off the credit card debt. How about the mortgage debt? I mean, so let's go on, and people just want to, you can basically buy your vote, right? Buy the vote and get elected, and then spread the money. It's more like a communism and socialism. That's the thing. And then for the fact, I really love the idea. You know, maybe one day I can do the same. I buy my own credit card debt, and then I reduce my own interest rate. It does not make sense, but it's happening. I don't know. I don't have the vision to see what's going to happen at the end. But I see, you know, especially after recent Ukraine conflict, the gold and silver, particularly, maybe, you know, mostly gold will play more and more important role in the financial system down the road.
No, I don't have anything.
Economic models are all great until you add human nature. After that, they all seem to kind of fall apart a bit. Here's a question for all of you. I'm going to start with you, John. Well, a two-part question. One, are we close to the bottom? And I'm talking about, you know, markets in general. If we are not, what does the bottom look like? I mean, is there anything people should be looking for to say, okay, when you start seeing this, then maybe we're getting to the bottom of this pullback we've had? Or do
Are you talking about resource companies or the
No,
general
I'm talking about
equity
the market, capital M, capital T.
The scenario we're looking at is interest rates being pushed up to crush inflation, which is only partly due to excess demand. There's supply disruptions that are going to keep it persistent. The Russia-Ukraine situation is not going to resolve itself anytime soon. Xi Jinping has a zero COVID policy that could really cause some serious problems in China because to get himself reelected in November, he can't have COVID go nuts in the country and make all the, suffering people endured in the past 2 years go to waste. So we have a scary situation of ever higher interest rates trying to crush inflation, whose nature is not the kind you can crush with monetary policy, and that's going to put loans underwater, and of course bonds are going to go down to reflect the higher interest rates and yields, and we're probably heading into a recession, and that should take the big markets down another level. But I'm bullish on the resource juniors because this problem of physical supply, it's a real problem in stuff like electric vehicles. Where's the lithium supposed to come from? And a lot of these other metals. And if China and Russia do forge this alliance, squaring off against the democracies, and the trade between them no longer happens, we're going to have to look for metals. I mean, you look at what America produces, it's pathetic compared to what China and Russia together pursue. So I think our sector is really going to blossom, even though there's extended misery coming for the general equity markets and the bond markets.
Okay. What about you? What do you think a bottom would look like, Chen?
Well, yeah, I do not know exactly what bottom looks like, but I feel we are close to a bottom, okay? But I don't know where exactly it could in a few months, okay? I invest in different sectors. As I said in my presentation, I invest in biotech, in energy, and in mining, okay, 3 sectors. And right now, I feel, okay, the most attractive the sector right now at this moment is biotech. I mean, people may not agree with me, but you look at the history, like 20-year history, this thing never happened in biotech. Biotech index dropped 60, 70%, and there's a short interest 60, 70% with the naked short almost 90%, maybe 100%. And then their cash trading at below, company trading at below cash we're talking about is 20-year, more than 20-year high. Okay, so it's like the crash. They will crash for different reasons. Okay, they were down last year and down this year because of all the Bitcoin or the other ARK thing. So that I feel very excited. If they're my subscriber here, you know my attitude. I did quite well consider how hard biotech market did, but my feeling is for biotech, maybe already bottom, maybe on the way up. And the gold, I'm kind of looking, one thing I want to say is that there's so many biotech trading at below cash, and some are trading at 1/6 of the cash level. People basically betting on that no biotech technology going to succeed in the next 5-10 years, which is not true, right? There are all these cancers, that company CKD, they have all the other, they're waiting to cure all these incurable Alzheimer's, all these incurable disease, I think will happen. Anyway, so, and it's independent of the market, because you cure a disease, what happened with the Fed, whatever. But so that's one of the sector. I'm quite excited. I think I'm doing well in certain stock. I'm looking to maybe taking profit later this year, and then I can put more money in mining sector. That's kind of excited. I also have energy, which is doing very well, and one of this, my big holding is going to liquidate, and the company running that is Goldbug, so he wants money to buy gold. That's good. I'm going to get the cash distribution. I think another company also going to get cash. So I have a lot of dry powder. So my point is, nobody knows exactly the bottom is, but from my back experience, the bottom is when gold start to rebound. Usually it's the lead indication of the bottom. So the gold dropped very hard in the past week. Usually that's an indication that people are selling everything, including the good stuff, like gold and gold miners. So definitely that's not a sign of bottom, but I think there's a bottom is near. And also people are selling all these other good things like Google, Apple, Costco. Those are good stock. Those good stock are sold at the last. Okay, so that's also an indication. You may argue interest rate will go higher. Those still are overvalued, but those are good companies generating a lot of free cash flow. So I got a feeling we are getting close. Okay. But the worst case part of it, I mean, one possibility would be an 87, it's like suddenly there's something Forex, something happening in Forex, then we have another crash. That will be the ultimate bottom. It's possible, okay, so.
Peter?
So I think that on the sentiment side, at least, that we're probably close to a near-term bottom. I think that we're probably set up for a decent rally over the next few months in general stocks, even bonds. Both of these would probably be temporary, like I say, for maybe a few months. And then I think that we're going to probably head for another leg down. The ultimate bottom, I think, is going to be much lower, but I think we're going to get these waves up and down, and we're going to get subsequent waves that are going to be increasingly lower, and this is going to play out like a slow motion train wreck, and it's going to pull down a lot of investors along the way, and that could probably draw out for multiple years before we finally reach a real bottom in stocks and bonds. Okay. Yeah, not pretty, but.
Thank you, Mr. Happy. I sort of agree, although I'm not quite as apocalyptic, maybe as, well, slow apocalyptic, I guess, as Peter is. I partially agree with Chen and John in the sense that there are definitely sectors where, you know, you definitely saw panic selling. You can't call it anything but panic selling in the last 2 weeks, but it has been sectoral. I mean, it's been meme stocks, it's been some of the larger tech stocks, not nearly as bad as the meme stocks, obviously crypto, a few other places. I'd be more comfortable if I'd seen something like that on, you know, Wall Street, if you will, on the SPX, and I wasn't getting that feeling. I mean, the selling was like very orderly. You know, every day it's off a few points, and yeah, there were a couple of bigger down days, but nothing to me that felt like panic or capitulation. So I'm kind of on the same track, I think, as Peter, where it feels to me like we're probably going to get a bit of a rally here, but I'd be careful because it doesn't feel to me like we've had the ultimate washout yet. I think there is going to be another down leg at some point. I don't know whether it goes 5% lower, 10% lower. I think a lot will depend on, well, I know a lot. It's going to depend on what the inflation curve looks like and the yield curves look like through the next 3 or 4 months. I mean, one thing I've been telling readers for months is, you know, for decades now, ever since Greenspan, really, you know, there was the Greenspan put, then the Bernanke put, then the Powell put. I don't think there is a Powell put. I mean, well, there is one somewhere, but when your central bank tells you in every speech, month after month after month, yes, we have a dual mandate, full employment and price control. Well, we've got full employment and prices are out of control, so we're going to lean on that mandate. I mean, when they tell you that 800 times, you should probably pay attention. And part of that statement is, there ain't no put here, boys. So if you think we're going to step in and freak out and drop rates because SPX drops 20%, nope, ain't gonna happen until we see some decline in inflation. And the other trigger for them would be not Wall Street. I mean, I'm sorry, Wall Street, but I don't think the Fed cares. It would be more employment based. If they really saw payrolls starting to fall off a cliff, if the monthly non-farm payroll went from 400,000 gain to 100,000 and 100,000 loss month after that, then I think you would see them back right off, ease, maybe even do some QE. But I don't think SPX going down 20% or 25% or 30%. They're not going to blink because of that. So, and I don't think that's a bad thing. I just think people need to keep that in mind. I think a lot of the optimism on Wall Street and the fact we haven't seen capitulation, there's this underlying feeling, there always has been. It's the whole we're the center of the universe thing. You know, obviously if stocks drop 20%, the Fed's going to step in because, like, well, we're us, so of course. I don't think they will this time. So keep in mind that you could see Wall Street slide 10 or 15%, and I don't think the Fed will blink. So then, you know, that's not a bad thing. I'm just saying, don't think there's some pre-measured level where you're going to see a bounce just because the Fed's going to do something, because they won't this time, not unless inflation's coming off. Sorry. But yeah, I overall don't think it's going like hugely lower, but I agree with Peter. I think we're going to have a rally, and I'm not sure what the ultimate low is, but I suspect on SPY it's, I don't know, 10, 15% lower than it is right now, ultimately, but probably a rally first.
We have been in a 40-year bull run.
Yeah.
It's gonna have to end at some time.
Yeah, I mean, and it's not, it's hard to think this way when you're in the middle of one of these things and you're spending all your days like me going, why didn't I sell that 3 months ago?
Exactly.
But, keep in mind, take a look at a long-term, S&P chart. I mean, bear markets are a lot shorter than bull markets.
Right.
There's way more bull market than there is for any, bull markets are, 80, 90% of the market in the last 30 years has been bull market, and maybe 10, 20%. That 10, 20% felt pretty shitty when you're in the middle of it. But, I guess that's my way of saying this too shall pass. I mean, we shouldn't all be looking for a bridge to jump off of or anything. It's not that, it's just the market. We're all going to get through it. Anybody else have a question? That would be a no. Okay, does anybody have, any of you guys have, I got a feeling I know what you're going to say, but does anyone have a favorite asset / commodity? If somebody said, okay, here's $1 million, Peter, you got to spend it before the end of the month.
Right.
Where would you put it?
Well, other than silver.
Okay, other than silver? Wow, okay. See, you threw me off right there.
I'm going to say.
You can say silver, it's fine.
Right, well, okay, silver and, I would say that palladium, platinum, in fact, in particular, is looking kind of cheap right now. I like uranium a lot right now. And some of the base metals have certainly gotten a lot more attractive in the last few weeks. Copper and nickel, even lead and zinc. The question is how you play them. Yeah. It's not always so obvious. Copper is certainly easier. But yeah, I mean, base metals, uranium, and even a couple of the platinum group metals.
Okay. Chen?
Oil's had quite the run. The stocks have had quite the run. I think that they can head higher, but I think they'll correct probably. I think there's some good odds they'll correct first, and then if you see them correct and then sort of move sideways a little bit, then depending what the environment's like, odds are probably good. They'll continue running a little higher again after that and have another rally. I don't think that's over. Gas and oil, you bet.
I mean, that's the problem with oil. I mean, every year that goes by, oil is a smaller part of the GDP, but it has a really big psychological impact. You can see the market structure right now. It wouldn't be that hard, and I'm not an oil and gas guy, but it wouldn't be that hard to argue that oil is going to go to, I don't know, pick a number, 150, 160. Problem, of course, is, oil is probably the commodity where high prices are the cure for high prices, probably unlike almost any other commodity, because it just has so much psychological impact. I mean, half the people I run into on any given day are bitching about gas prices and stuff, and I don't blame them. I mean, the prices are crazy. It has a real impact on consumer sentiment. So, yeah, in this market, I could see oil going to 150. It wouldn't surprise me even a little bit, really, because nobody's explained to me yet how these EU countries, if they're actually going to do this, if they're actually going to drop off Russian oil, there isn't really 6 or 8 million barrels a day sitting around anywhere that I know of. So if they actually do that, then yeah, oil probably goes to 150, 160. Unfortunately, that means we also go into a recession. So it's not going to stay there. So if you're going to ride it to levels like that it could get to, be nimble, because it probably will. It is the commodity where high prices are the cure for high prices.
Yeah, exactly. I mean, I kind of surprised how you stay so high for so long, but the Ukraine war is part of contribution to that. I mean, if my subscriber was here, I mean, I got into Valara, for example, last downturn at $30. At that time, they pay more than 10% dividend. It's very nice. I mean, I couldn't hold it so high. I mean, right now it's over 100. I mean, oh my God, I sold it too early, but I don't think I can hold. I would buy at the current price because exactly you know, at these other panels said they were, high oil price will kill high oil price. It's a self-inflicting pain. It will force people to get away from oil energy, you know, more electrical car, more solar panel. It takes a while, but when they hurt, it will hurt so hard. So we'll have a next downturn maybe in a few years, and so oil may go negative again. My goodness, I don't, you know, if you invest in cyclical industry, this is not time to, my personal opinion, it's time to buy oil, but sell oil. I have a lot of oil stock, and I'm looking to you know, to get out of it, right? To use the money to buy gold and silver and other miners and on the cheap. So, so that's my general. And if there's anything, I think you know, have a very good risk reward in this world in all the different commodity. I think it's probably platinum. If you come to my panel, right now platinum is 900 something. There seems to be had unlimited appetite from China to buy platinum when it's below 1,000. Right? So it's buying range from China's buying range. And most importantly, South Africa's platinum mine is contract up to renegotiation this year, okay. Last year, they have a bloody strike. Platinum went up $1,000 on the strike news. So you think about right now 900, you know, that's a lot of upside from here. And plus also platinum, I mean, you can replace palladium in automobile. So there's a lot of things going. I think that could be a safe asset. If you tell me to put money in copper or zinc, I'm not sure, because they can potentially go low, you know, if China really shutdown is getting longer, or there's other things, those base metals can get lower. But if you bet on the platinum seems to have, this year, particularly this year, it's in a very good risk reward. If God forgiven, there's another strike, a bloody strike, because those union in South Africa, if you remember, they are very military, right? They go and kill people who go to work, and then there will be blood on the street, they will be all over the news, and then platinum will spike, and you sell on the spike. Remember to sell it. you don't just buy and hold. This is not a buy and hold trade. But if you want buy and hold, I like silver. As if you come to my panel, as I said, I think silver really will take off. Maybe in a few months, when people realize how important silver is to the new green industry, especially solar panel. So that's my picks.
John?
So what was the question?
Do you have, yeah, if I give you $1 million, and it can be either like metals, commodities, or sectors, I mean, where would you be putting money right now if you were putting it anywhere?
But was it supposed to be selling in a month?
No.
Oh, so
no.
longer term.
Yeah, just
Longer term, okay. So I'll give kind of a strange answer. You can't really buy lithium carbonate because it's an industrial type mineral. It went from $3 to $36 a pound in the past couple years. And at $36 a pound, that's not sustainable. So when you see that lithium carbonate price start coming down towards $10 a pound, and cross your finger that it stops there and bounces there, then you have a pegmatite lithium boom happening to make sure all those electric vehicles in 2035 become reality. So that's what I'm looking at now, is the lithium pegmatite sector, not so much the brines, but the lithium pegmatite sector. And perversely, the price coming down is actually good for the story. Usually when something goes exponential and then comes back, everybody gets sad and abandons it. This is a different type of scenario.
Well, okay, so why is it different, though?
Because at $36 a pound, the million tons of lithium metal that you need for all those electric vehicles, that would be a $400 billion a year market, bigger than the global market for aluminum. So can you imagine that lithium becomes that valuable? And of course, if it's that expensive, do you think an ordinary consumer will be able to afford an electric vehicle? No, so it has to come back down to $10, and that's sort of where these 1 to 2% pegmatite deposits start to work. And the brines can only do so much. The claystones could do a lot, but you need a much higher price to get an infinite supply from them. So it coming back down, that's actually going to be a really good thing to kick off what I call Lithium Mania 2.0.
Okay. Interesting.
Do you see any threat of sodium battery? I was hearing a lot.
Don't get complicated.
A lot of news. There's a new generation of sodium battery coming out.
Well, I'll believe it when I see it.
Okay. Still no. What was that? I mean, I think somebody sort of asked you. If you want to ask at the microphone. And I'm just saying that because the people online, and there's a bunch of them, they can't actually hear you unless you speak into the mic.
What are your thoughts on uranium prices for the future?
I stopped being a uranium bug the night of Fukushima, and I just never really got back into it, honestly. I hung on to a couple of them I did well out of. I mean, the short answer is it should go higher. A lot, I think, is going to depend on geopolitics. Amazingly, to me, you know, we're hopefully seeing a political move swinging back to logic again in places like Europe. Although even now they're pretty, you know, they seem to have their feet in both camps, and there's very few politicians that are going, oh, well, yeah, obviously we should turn the reactors back on, duh. I haven't followed the reactor news close enough, but a lot of people have been talking about these mini reactors, and if those work as well as they claim, and the capex is as low as they claim, that's going to have a really big positive impact. But then I wouldn't have a lot of trouble imagining like a triple-digit uranium price, because there's not that many easy deposits. There's a handful, but there's not really that many.
Well, I agree with Eric in terms of the upside. I think that you do have governments, obviously not everywhere, not yet, not that many, but you do have some starting to agree that it's a green form of energy because of the lack of greenhouse gases and lack of pollution. And I think that when the markets come to terms with the fact that, you know, there's a limited range of economic ways of producing energy, not that you can't just print money to produce these anyways, which is seemingly happening by subsidizing all kinds of industries, but when the market comes to terms with the fact that there's only so many ways that you can produce green energy, I think that they will embrace nuclear in a much bigger way, and that's going to help certainly push prices a whole lot higher. And triple digits for me is certainly very likely, I think.
Yeah. Well, I have a different perspective, right? So, well, all these commodity markets are highly manipulated. I'm sorry. Okay, that's the way it is. Yeah. So for all these smart hedge funds who buy, you know, CCJ, buy all these uranium miners at the low, they would want a way out. You think about them, those, you know, smart people and with a lot of money. So the way out would be push uranium to triple digit. That's why I agree with it. They will push uranium to triple digit, and then they will sell uranium miner. That's how they make money, and then they walk away for 5-10 years. And so for your investor, if right now I think a little bit late to the uranium game, but one way could play with the uranium spot price or the uranium ETF was you ride it to, you know, you set a target in your mind. You have to remember, that's my target. If they hit 100 or hit 120, 125, you have to write it. Okay, even you write it on the mirror or something every morning. When they hit it, you get out, make money. That's most important. I mean, you invest, you're here to make money, not to lose money, not for some passions or some belief. But what I think, okay, the highly likely case is uranium could hit triple digit. And then it's not because supply demand. It could possibly because of manipulation.
I need to get you to just start phoning me and telling me to sell, okay, Chen? I really suck at that. I got to get Chen to call me and just say, get the hell out. I told you to sell.
Well, that's my newsletter that what's Chen selling. I'm buying and selling. I'm trying to tell people when to sell. I mean, because I've seen so many people, they buy and hold and they just got stuck with some stock, some juniors. I want to, it's very difficult. I have to tell them. Sometimes you need to sell.
Good advice.
So if the projected supply-demand imbalance for uranium in the longer term, 2030 and beyond, is to be resolved, assuming the inflation we have now goes back down to a lower level, we need $60 to $80 a pound uranium to mobilize new uranium supply. And the Sprott Trust has, got it up to 60, it's back to 50, but it needs to end up stabilizing in that 60-80 range, and the utilities get used to the idea of, okay, we're going to do long-term contracts at that price. I don't see uranium as a go-to-the-moon type of speculation, but I see it going back to a normal price range where it makes sense to put MacArthur back online and look for more deposits in the Athabasca Basin or elsewhere. That is the key. That's what we need to get the uranium juniors alive again and properly funded to do the exploration to generate the future uranium supply needed for long-term nuclear energy power plant requirements.
Okay. Anybody else have a question? No? Okay, I think, oh, you got one? Okay. Oh, you got two.
Just say we get interest rates up to about 3%. How's that going to affect everything, like, mining, everything, economy, recession? Like, what's your views on that? And that's, I think, that's really where we are right now.
Well, I mean, one thing about interest rates to keep in mind is everybody gets fixated. I mean, the financial press gets fixated. Everybody gets fixated on what's the Fed going to do, what's the Bank of Canada doing, what's the Bank of whatever going to do. Keep in mind that when it comes to, long-term rates getting set, mortgages getting set, they don't get set by the Fed, they get set by the bond market. So if you look at the bond market right now, 10-year yields are about 2.75 today, I think. 2-year yields are about, 2 and a bit. We're actually a lot closer than people think. I mean, everyone's fixated on the Fed moving rates to 3%, but the bond market, I mean, that's what the yield curve does. The bond market's pretty much priced in what the market thinks the Fed is going to do as of today. Where you might run into a problem or, or a happier market is basically the yield curve shifting because the bond market decides oh shit, 3 more 50-point increases isn't going to be enough based on what we're seeing with inflation trends. So the bond market pushes yields up, pushes 10-year up to say 3.5%, 4%, and that is what that yield is what gets used to price all kinds of things in the broader debt market. It's not really priced based on the Fed; it's priced based on the bond market. So a lot of that's priced in already. I mean, conversely, if suddenly the economic metrics and data points started coming out and they look like crap, you would see people diving into the bond market and they would pull the whole yield curve down. So I'm not sure 3% is something that would blow anything up, because basically what I'm saying is we're pretty much there, because it's really, I mean, as much as CNBC will, have conniptions and do 3-day specials with big glaring headlines, the truth of the matter is it's not the Fed, it's the bond market, and they've kind of done it already. Anybody else got any thoughts on that?
Hi, what do you guys think of carbon credits as a way to play the green revolution?
I don't know that market really well. I know it semi well. It is kind of a strange. I find it philosophically kind of strange that carbon credits would even work at one level. I know it. I mean, they become a big thing in Europe. Credit prices have fallen off quite a bit because of Ukraine, right? I mean, suddenly everybody's going, well, okay, that's not the main thing we should worry about. My sense, though, is Europe, which is kind of the epicenter, really, of the carbon credit market, I don't get the sense that politicians are backing off on that at all, really. I mean, the market has pushed things down because, well, and also there's just some of the biggest buyers, you know, things like smelters, refineries, stuff like that. A lot of those have had a lot of shut-ins because the power prices are so high. I can see the logic of that market sort of going a lot higher. I mean, you know, full disclosure, I bought a fairly large chunk in a carbon credit deal that's still private that a friend of mine set up. And, you know, he had to kind of baby talk me through the whole thing. And it was kind of like, yeah, okay, I could see how this could be like a Bitcoin, which is not a compliment, by the way. I could see how it could be something where, you know, once everybody finds it, carbon credits go from like, you know, $80 to $800. Like that wouldn't shock me. I'm not sure whether you're going to see politicians step into that because they're trying to get those to be used to bring emissions down. But I do see it as a viable, I guess, fair way for companies that have no choice but to pollute. I mean, they're in inherently polluting sectors, and some of them just are. That's how it is. I mean, you want copper, then you send copper concentrate to a refinery, and refineries create pollution. That's how it is. But I think, I do wonder, even as somebody that just bought into one of those deals, is there a point at which the government has to step in and say, look, we can't let these get any more expensive, because if they do, like that sector and that sector and that sector go tits up. Like there's a point at which you're going to have to either give the polluting sectors a break in terms of carbon credit prices, or accept the fact that you just don't want those sectors. I mean, we're talking Europe, so it's not out of the question they'll say, yeah, we don't want those sectors. I'm not sure how much carbon credit demand that's going to destroy, though. But yeah, I thought it was an interesting enough idea that I bought a schwack of the private deal. I can see it as something that, yeah, it'll probably have a run at some point. I was kind of hoping it was going to be this year, but it's not looking that way. Is anybody else playing with those?
I mean, I actually am involved in a deal as well, but that's not public yet.
Okay.
So that's interesting. And
Probably the same one?
perhaps. We'll talk later.
All right.
And as much as it seems like it feels like an artificial ecosphere, I'm not sure that it's going away. And I think that it's still very early days. There's not much to participate in yet, but I think that's coming. And as much as I hate to admit it, I think it could be another bubble. You know, it might take some time to play out, but I could see a bubble early on, and that'll pop in terms of valuations, and then back to more realistic. But I don't think it's necessarily because of government support. It's not something that's going to go away either.
Yeah, it really comes down to, do things like the Ukraine war change the timetable for the governments? Because ultimately what would drive very large demand for carbon credits is simply the government forcing that demand by saying, you know, henceforth, here's your top emission cap, and above this, you know, we're going to shut you down, or you've got to find some way to decrease your emissions, or you have to buy carbon credits to offset. And really the marketing, I guess, if you want to put it this way, the marketing behind a lot of these carbon deals I've seen is, you know, the EU right now they're talking about, yeah, we're going to make it tougher in 3 years, we're going to make it tougher again in 5 years, we're going to make it tougher again in 10 years. And if they stick to that schedule, it will inherently increase the demand, just because companies have to get these or they go out of business. Where, yeah, you could see a real run on it. Ironically, or maybe not ironically, if you're as cynical as I am, I don't think the bureaucrats that put this together really thought about the idea that the price of the carbon credit was, like, I think they thought they were going to be able to just set that by fiat. It's like, yeah, no, that's not how it works. You have let the genie out of the bottle, and you don't know where the stopper is, so it's going to go where it's going to go. And I'm not sure how the bureaucrats are going to deal with that. I think it's starting to dawn on them, like, oh shit, like I might have set up a market where it's going to price itself out of existence, but I don't see a solution. And I agree with Peter, like, before anybody figures out a solution, it's quite possible it'll go up a hell of a lot first. So yeah, that's why I bought the stock.
Classic.
You guys are the smart guys getting early. So, well, my concern, I mean, I don't invest in carbon credit, but my concern is it will change the industry as we know it, right? So because mining company, we evaluate, they have a different costs, what's the cost, what's the metal price. But then in the future, if you look at the carbon credit, the underground, open pit will have very different energy intensity. So they will change the mining industry, as we know, upside down. That's my concern, especially if Eric said he's right, it's a bubble, and then we'll go way up, and then some company may go bankrupt. They may was a profitable gold mining company, gold miner, they could go bankrupt. So that's collateral damage.
Yeah, I really think when they set it up, they thought they were going to be able to regulate the market size and regulate the price. But once it became an open market where individual buyers and sellers could trade the credits so that people that needed them could get them, and somebody that had like 1 million acres of forest could, kind of gizmo these things together and sell it to somebody that was running a steel mill. I don't think they realized that once that the genie was out of the bottle and it was a private market, that the private market and not them was going to set the carbon price. So I think there's a high probability you see a real run in it at some point. We're going to have to get past things like the Ukraine war, because I just don't think people are going to care much about this stuff right now. If that kind of stuff gets settled, then yeah, could I see carbon credits going to 300, 500, 800 bucks? Yep, they probably will, especially because the bureaucrats keep saying, well, we're not going to change the schedule. Like these emission schedules aren't going to change. We're going to tighten the screws every couple of years. That's just how it is. So figure out a way to deal with it. And part of the way is going to be a lot of more expensive carbon credits.
I had read about a year or year and a half ago that if you looked at how Tesla was making money, they were actually not making any money from cars. It was all from carbon credits.
Yeah. Mm-hmm.
Like that was their actual source of profit, not from cars. So gives you some idea.
Yeah. It's a very weird market. It's a very, very weird market. I'm still kind of getting my head around it, but
seems very
at a speculative level, yeah, I could definitely see it. And then I have to get Chen to pull me, of course. Obviously, Eric, get the hell out.
You'll have to call Eric.
Got my phone ready.
Do you have any thoughts on carbon credits?
Yeah, if you want a free lunch bet on carbon credits, buy FPX nickel. Now, their flagship project is a Dakar nickel project, very low grade, but it's a natural stainless steel called awaroite, billions of tons. The stock in the 50-60 cents is about a quarter of where it should be based on the PEA that they did. But as part of their search for similar such deposits, they realized that there were all these duds, similar ophiolites that don't have the awaroite, but did have the magnesium mineral brucite, which tends to also form in this type of system. And they've done work now to figure out how you could take carbon from various sources where they need to get rid of it and inject it in water and expose it to this brucite mineral, and it creates a carbonate mineral that's permanently packing away the carbon in a verifiable manner. They own 76% of the subsidiary that's doing that. The market gives it no value for it. But if you optimistic that maybe long-term there will be a market for carbon credit type thing in North America, FPX nickel is a free way to participate in that without suffering any downside from that not happening.
Yeah, I'm a fan of that one too. I like that. I like that project a lot. And yeah, something that isn't built into the price yet, that didn't, John talked about the subsidiary that may or may not have been something I bought. And the brucite thing's pretty interesting. If they can get that to work and basically lay out Dakar as, not only is this a potential low-cost nickel mine, if their sales pitches, it's a potential low-cost, zero-emission nickel mine because of the brucite. Hello, Elon. Somebody like that in the whole green environment. Yep. I would be shocked if somebody like that, probably outside the mining sector, honestly, that will probably screw the mine up, but that's their problem. But just some random tech bro shows up and goes, "Awesome, I'll pay $1 billion for that. Why not?" Like, I honestly wouldn't be shocked to see that happen. Goofy, but hey, if turns a profit, it turns a profit, right? Let's not get too pedantic about these things.